Every year, thousands of American homeowners over the age of 62 sign documents that they believe will give them financial freedom for the rest of their lives. Within a few years, a significant number of them are in default. Some lose the home they spent decades building equity in. Others leave their heirs with nothing. And the most unsettling part is that nearly all of them were told they could not lose their home. That is the brutal truth about reverse mortgages that this video is going to walk through clearly, completely, and without the sales pitch. This is a general educational overview, and how a reverse mortgage plays out depends heavily on your personal situation. What a reverse mortgage actually is. A reverse mortgage is a loan. That single sentence is the most important thing to understand before anything else. It is not a government benefit. It is not free money. It is not an entitlement program. It is a loan secured against your home, and like every loan, it comes with costs, conditions, and consequences. The most common type is the home equity conversion mortgage, widely known as a HECM. It is insured by the Federal Housing Administration and available to homeowners aged 62 and older. The FHA introduced it in 1989 through the Department of Housing and Urban Development to standardize what had previously been a largely unregulated market. There are also proprietary reverse mortgage products from private lenders, sometimes available to homeowners as young as 55, that are not FHA insured and carry their own separate terms. The basic structure works like this. You own a home with equity. Instead of making monthly mortgage payments to a lender, the lender makes payments to you or provides a lump sum or opens a line of credit depending on how you structure the loan. The loan balance grows over time as interest and fees accumulate. When you sell the home, move out permanently, or pass away, the loan becomes due. The home is typically sold to repay it. If the sale price covers the balance, any remaining equity goes to you or your heirs. If the sale price falls short, the FHA insurance covers the difference under the HECM program. That is called a non-recourse protection, and it means your heirs will never personally owe more than the home is worth. That protection is real. But it is only one piece of a much more complicated picture. The costs nobody puts on the billboard. Reverse mortgage advertising has a long and documented history of emphasizing flexibility and freedom while minimizing the costs involved. The Consumer Financial Protection Bureau has formally taken enforcement action against multiple major reverse mortgage companies for deceptive marketing, including false claims that borrowers could never lose their home and that the loan came with no payments. Here is what the actual cost structure looks like for a standard HECM. The upfront mortgage insurance premium is 2% of the home's appraised value or the FHA lending limit, whichever is lower. On a $400,000 home, that is $8,000 paid at closing. Origination fees can reach up to $6,000 depending on the lender. Add standard closing costs including appraisal, title insurance, and other administrative fees, and the total upfront cost on a typical reverse mortgage can exceed $15,000 to $20,000, most of which is financed into the loan balance rather than paid out of pocket, which simply means you start deeper in debt from day one. Then there is the ongoing annual mortgage insurance premium of 0.5% of the outstanding loan balance charged every year. And the interest rate. As of 2026, reverse mortgage interest rates have been tracking in the range of 7% to 8% annually for variable rate products. This interest is not paid monthly. It accrues, compounds, and is added to your loan balance every single month. Consider a $200,000 initial loan balance at 7.5% annual interest. After 10 years with no payments, no additional draws, and the 0.5% annual MIP factored in, that balance has grown to well over $420,000. After 20 years, you are looking at a balance approaching $900,000 depending on compounding frequency. Your equity, the financial asset you spent your working life building, is being systematically consumed whether you ever write a check or not. The obligations that catch people off guard. Here is where many borrowers get into serious trouble. A reverse mortgage does not eliminate your financial obligations as a homeowner. It eliminates your monthly mortgage payment. Everything else remains squarely your responsibility, and failing to meet those obligations can result in the loan being called due immediately. You must continue paying property taxes in full and on time. You must maintain a valid homeowner's insurance policy at all times. You must keep the home in reasonable physical condition as defined in your loan terms. And critically, the home must remain your primary residence. If you are absent from the home for more than 12 consecutive months, including for medical reasons such as a stay in a rehabilitation facility or memory care unit, the lender can declare the loan due and begin the process to recover the balance. That 12-month occupancy rule is one of the most consequential and underappreciated details in the entire reverse mortgage structure. A senior who takes a reverse mortgage at 68, suffers a medical event at 74, and spends 13 months in long-term care may return home to find the loan in default. According to CBS News, this scenario has become increasingly common as seniors underestimate the ongoing financial commitments required to maintain a reverse mortgage in good standing. If you are thinking more carefully about whether a reverse mortgage is the right tool for your situation after hearing this, take a second right now and hit the like button. It helps this channel reach more people who need straightforward, unbiased financial education. What happens to your heirs? When you pass away or permanently vacate the home, your heirs typically have 30 days to decide what to do, with extensions available from the servicer under HUD guidelines in most circumstances. Their options are to sell the home and use the proceeds to repay the loan balance, keeping any equity that remains. To pay off the loan balance themselves with outside funds and keep the home. Or to allow the lender to take the home through a deed in lieu process if the loan balance exceeds the home's value. Under the non-recourse protection of a HECM, heirs are never personally liable for a shortfall. But if the loan balance has grown to equal or exceed the home's value after years of compounding interest, they may inherit a property that delivers nothing or very little in actual value. For many families that anticipated using home equity as part of an inheritance plan, a reverse mortgage can eliminate that expectation entirely. Where it may or may not fit. With all of that clearly understood, it is also accurate to say that a reverse mortgage is not inherently the wrong choice for every senior. Used in the right circumstances, it can serve a legitimate function. It may make sense for a homeowner who is asset-rich but cash-poor, has no intention of ever moving, has no heirs who depend on inheriting the property, and has fully modeled the long-term cost trajectory with a HUD-approved reverse mortgage counselor, which is a federally required step before closing on a HECM. It almost certainly does not make sense for someone who is considering it to delay Social Security, expecting to move within 5 to 10 years, dealing with inconsistent income that may make property tax payments difficult, or hoping to leave the home to children or other heirs. The alternatives are worth understanding clearly. A home equity line of credit, commonly called a HELOC, allows you to borrow against equity at significantly lower upfront costs, with interest only accruing on what you draw. Downsizing involves selling a higher value home, extracting equity directly, and moving to a less expensive property that reduces ongoing costs. Both options preserve far more of your equity and your financial flexibility over time compared to a reverse mortgage. The honest bottom line. A reverse mortgage is a financial product designed by lenders, regulated by the government, and marketed to seniors with considerable resources and skill. The non-recourse protection is real. The FHA oversight is real. But the compounding debt, the erosion of equity, the occupancy requirements, and the ongoing obligations that can trigger default are equally real. Before signing anything, you are required by federal law to complete counseling with a HUD-approved reverse mortgage counselor. That session exists precisely because the product is complex, the long-term costs are substantial, and many borrowers sign without fully understanding what they have committed to. Use the counseling session, run the complete 20-year cost projection with your advisor, and make sure the choice you make is based on the real math, not a television advertisement. If this gave you a clearer picture of how reverse mortgages actually work, subscribe to this channel right now. Every week covers retirement income strategies, financial planning fundamentals, and the kind of direct, research-backed analysis that helps you make decisions with real confidence. Subscribing takes 1 second, and the next video you see here might be the one that protects your financial future.